Here is the harsh reality about Australian property investment right now. With interest rates where they are, the average investment property is costing owners between $300 to $800 per month out of their pocket in negative cash flow or negative gearing. That's $3,600 to $9,600 per year just to keep the lights on. And for most working Australians, this is a massive financial strain that forces them to either sell up or miss out on building wealth entirely through property. But here's what most banks and property advisors will not tell you. There is specific strategy that turns monthly costs into monthly income. So in this video, I'm going to show you the cash flow hack that's been hiding in plain sight. Why 95% of Australian property investors are getting this terribly wrong. And the 3 specific points that turn any property into a cash generating machine. One of the very important things that I want to explain today in regards to the terminology of positive gearing is that 99% of investors out there don't actually understand what positive gearing means and what it actually looks like from a cash flow perspective and what it actually looks like behind the scenes when it looks like numbers like this. So right now, what we've done is put together a very basic cash flow sheet, which I'm going to take you through step by step and show you what a property looks like if it is positive geared, because there is key differences between positive geared properties and there's also a thing called positive cash flow properties. There's also things called neutral gearing or neutral cash flow properties. So this cash flow sheet behind me is based off a property that we picked up for one of our buyer's agency clients, but it was basically an affordable $388,000 property within the Melbourne metro market. 2 bedrooms, 2 bathroom, 1 car garage, and a good sized courtyard / backyard as well. And at the time, we had a rental appraisal from property managers of up to $490 per week. So that basically works out to be a 6.56% gross rental yield, which for the Melbourne market and any metro location is actually quite good, especially for a townhouse that is modern. This property that we picked up was only about 8 to 12 years old as well. Now this section, which is section 3 over here, is broken down weekly, monthly, annually. We've combined council rates and water rates. Roughly, that worked out to be $2,310 per year, or that amount per month, or that amount per week. The next thing, management fees. We got the management fees down to only $1,606 in total. Insurance / strata. This was a townhouse, but it basically didn't even have any strata fees because it had its own plot of land associated. They had like a body corporate, but it was basically not like you buy in a massive high-rise with elevators, pools, gyms, and all that other kind of stuff. So including the building insurance, the actual strata was only about $1,600 per year, which includes the building insurance. So it's about $400 a quarter, which is great. The next thing is the repayments. And now it's IO for interest only. When you're doing a cash flow sheet like this, it is best practice to just go off interest only because you will likely be able to build your portfolio faster. And the faster you can scale it up, the faster then you can have the compound capital growth effect and the more money you'll make. So hope that helps. So again, interest only, $382 per week. Obviously we've got principal, which is being 0. We don't want to pay the loan off right now. We just want to have the property, overall look after itself. Mainly we want to be able to get equity out of this property because we bought it at $388. It's worth $440. We want to be able to extract the equity out. So overall total, you're looking at $488 as an example in terms of expenses, or $21.15 per month, or $25,381 per year in expenses, right? The next thing was the property was actually rented already for $460 per week, but you could easily put it up to $490 per week when it comes up for renewal. That's obviously income and that's the expenses. Over here is the cash flow before tax. Now let me make this very clear. This is not positive gearing or it is not negative gearing. Gearing refers to what is done after you have got your tax return done and doesn't just take into consideration just this stuff right here, because this stuff right here does not include things like depreciation benefits, and it does not include things like maintenance, or if something happened to the property and you've got to spend $5,000 on a repair, Not in this case, because it was a great property. Things come up. So you can't always factor in, and you shouldn't always factor everything in, especially when you're working out pre-tax cash flow. Positive gearing right now in 2025 to 2030 essentially does not exist, especially if you are a starting off property investor that you are putting down a 5, 10, or 20% deposit. You should not even be thinking that your property is going to be positive geared at all for the next 3 to 5 years. So I am talking to everyone out there that has between 1 and 10 properties right now. You should understand that you're not aiming for positive gearing. You should be aiming for massive equity growth and buying properties that are under bank valuation, properties that have instant equity on the way in. Like this property as an example right here, it's only going to be $2 a week positive at best. Bear in mind, this is before the rate cut, so it's probably going to be more than that. You know, it might be $10 a week positive, but it's not about positive gearing. Positive gearing is not a good thing, right? Neither is negative gearing. Neither is neutral gearing. The best thing is to create a wealth machine, a portfolio of 5 or 10 or 20 or 100 or 1,000 properties that will consistently have capital growth, grow in value, and you can take out tax-free equity from all the properties that you own. And that's what I personally do. You don't get wealthy or rich through cash flow. You get wealthy and rich through equity and the actual assets rising in value and eventually the loans going down and the properties continually to go up. Now, when we're talking about this property, let's say as an example, it wasn't renting for just $490 per week. Let's hypothetically assume that this rent went up to $590 per week. So now we'd be $100 per week positive cash flow. What does that look like? Now, because this property was a townhouse, so we picked up for $388,000 and it was relatively modern, it was only about 9 to 12 years old, it has what you call Division 43 tax depreciation, which over this point right here, it had about $6,000 per year in depreciation benefits, which basically means if this bit, hypothetically, the property was positive cash flow by $100 a week, then that would basically make it per year $5,200 positive cash flow. However, this property would still not be positive geared because it has depreciation benefits, estimated depreciation minus $6,000 per year. You take your per year positive cash flow and you basically have to minus that by your negative depreciation benefits. That is basically on paper losses. You're not physically losing that in cash flow. So while you might be making $5,200 per year in positive cash flow, when you minus $6,000, what it looks like on paper, it's technically still negative $800 per year, which is then pushes it into the category of negative gearing. So technically this property, even if it was rented for $100 a week more at $590 per week, it would still be negative geared. Positive gearing does not exist in 2025. You shouldn't be using the terminology of positive gearing at all. You should be using the terminology of good cash flow in a very vague sense. You should be using neutral cash flow or have a slightly negative geared property. Even if you get to 10 properties in your portfolio and they're negative $1,000 per year and you've got 10 of them. So your entire portfolio is negative by $10,000, which is the equivalent of $200 a week. It is basically like forced savings. So in my scenario, my personal property portfolio of over $100 million, even if I just get an average growth rate of 5% per year, 5% of 100 million is $5 million in equity just this year. So each year I'm going to make $5 million in equity, which hypothetically, again, if I sold a property or properties that was in that amount, and I sold $5 million worth of property, even if there was 50% loans on them, I would still be able to pay tax and then have, $3 million as an example in cash in the bank to then redeploy to buy more assets or then re-leverage or just keep them and then just keep buying more property. But finding these positive gearing deals is only half of the battle. The real skill is knowing how to identify properties that are genuinely undervalued. Because when you can find properties cheaper than everyone else, you're not just getting positive cash flow, you're getting an instant equity the moment you buy. So make sure to watch my next video where I reveal how I consistently find property deals up to 30% cheaper than market value and how you can do the same as well.